Welcome back to another Market Insight call. It is September. We're back, just us, no more guests. So joined as always by Aaron Tuttle.
It's good to be here, Chris.
Yeah. Well, let's get into it. We have an outline. It is Fed Day, September 18th, 3 o'clock when we're recording. And we'll start today with an S&P 500 chart. We'll move into some of the recent economic data, which is there's a lot of inflation, employment, the leading economic indicators, which the yield curve is part of that. We'll look at what the Fed had to say today about the data points. We'll move to their summary economic projections, and we'll close with our forecast on interest rates.
And if you haven't subscribed yet, make sure you do, because next month we're going to have the GLD founder on. He's going to be talking about gold. You don't want to miss it. Hit that subscribe button. Make sure you share it with your friends so they're able to also listen in. Thank you.
So let's just start with the S&P 500. This is just a 2-year chart looking at the past cycles that we've seen. It starts with seasonal weakness. 2022 was a terrible year for stocks. And we pick up the chart here at the end of October, bottom left on the chart, where we start a nice strong rally following that seasonal weakness period, 30% off the low. Enter another period of seasonal weakness, the July through October, which becomes very choppy. Another 38% return off that low. And we get here today, this summer, and towards the end and entering fall, where we've had a lot of volatility. I'm not saying there's going to be a repeat exactly of this, where we have these 30% rebounds off of 10% pullbacks, but economists, forecasters generally don't like to make big predictions like that, but it is what you see. The market tends to average 8 to 10%. So rarely do you get that. You rarely get that average.
I would say there's a reason technical indicators are something that a lot of people use, right? Is because they often rhyme. It'll always be a little bit different, but the way that the market processes things and thinks about things and looks at on a seasonality chart, whether it's self-fulfilling or not, they continually follow a similar pattern.
You get a lot of years where you're going to have 20% returns, and then the negative returns get you right back to that average of 8 to 10. And I think it's something that can happen if we continue to see some of these strong indicators that we'll be looking at.
It's certainly something that we consider whenever we're doing our cash management balance. If we think about it, we're back or getting close to where we were able to raise cash, but we raised cash before that sell-off, right? And a lot of that is just paying attention to the technicals. What are they telling you? What's a pattern?
Made people a lot more comfortable during that sell-off. We'll just close here with the other S&P chart, zooming in on more recent. This is 1 year, looking again at that trend moving up, and then that volatility we've seen, which we spent a lot of time last month talking with Jeff Weniger, but that yen carry trade, really some unemployment rate moving up higher too, scared the markets. Earnings season, which I thought was pretty good. The market originally went back and forth on it. Probably something to see with today with the Fed meeting where the market was moving back and forth, couldn't make up their mind.
I was going to say, if we were looking at today's chart, it would look more like a heartbeat, right? As these things. But I think a lot of that carry trade also is resolved after today because interest rates begin to move lower. So that trade will start to be unwound. That's probably some of the reason that we've had such volatility after the announcement.
And that last move on the chart in the top right was a recovery from some of that sell-off, which we'll talk about on the next slide, which happened with NVIDIA and Broadcom, the really high flowers, AI trade. It was a good earnings season. Final thing we looked at is next earnings date, which is already almost here. Next month, we got our companies starting to report again, and we'll see the Q3 earnings season. Let's move to their econ data. And the first is our inflation numbers, which we have two measures of inflation here, CPI and PCE. We got an updated CPI most recently. That's why the line is longer than the PCE. We're still waiting on that for next week. And then the purple pink line is the Fed funds rate. As of earlier this morning, they have reduced interest rates, their Fed funds rate, by 50 basis points. And a lot of that was talking about, well, should it be 25 or 50? And we said originally that was really just a talking point to fill the airwaves. That really wasn't going to matter if it was 25 or 50. It was all going to be, well, what are they projecting forward? Because that's really what matters, is what's going to happen 6 months from now. We'll talk about that slide when we get there. But the good news from inflation, the trend was down, strong disinflation, of CPI, which does move a little bit slower than PCE, and PCE tends to be underneath CPI. So market was pretty happy to see CPI moving down.
So what were the main factors that really drove this down?
Yeah. So one of the big ones is probably the big risk, which is energy. Energy prices have been down. So should there be, and I was watching the press conference before that, they really didn't even talk about that with the risk to inflation, at least with the Fed, is if there is something that causes energy prices to move back up, maybe interest rates move back up as well on the long end, not the short end of interest rates, the part that's priced in by the market. Those are kind of the two big risks to inflation, and then repricing of the market, something you talk all the time about, it's discounting your cash flows by rates that are not as low as they were today.
So we have energy bringing it down, and this is with the current administration kind of pulling back on some supply. If there was a change during the next election, that probably brings more energy on, as fracking would be easier to do in the U.S. So either way, those seem to be favoring disinflation going forward. And when we say disinflation, we mean that there's still positive inflation. You're still going to see prices go up, just not the way that they did right after COVID. So this is certainly a nice position to be in, where you actually get real rates, right? There's plenty of room here for the Fed to cut back. But the other one would be housing prices. And that's the one that I think is most concerning on inflation coming back, at least in my mind, because as interest rates go down, when you're looking to buy a house, you look at your monthly mortgage, as interest rates are becoming smaller, that means that shelter prices could begin to go back up if we have lower interest rates. So I wouldn't be too concerned about energy based on what we know now. I do think one thing that you want to pay attention to is just the housing price if interest rates begin to lower.
And those haven't really helped much. Those have been pretty sticky. That's one of the main part keeping it. So like you said, could that push it back up even higher? That's certainly one of the big risks.
And that way that number is factored in this index, it takes a while for that to actually get priced in. So probably not a really big near-term risk of inflation moving back up in the indexes.
And the big change to this Fed meeting and the shift that's been happening the last few months is moving from inflation as being their main focus to employment. Right. The first 20 minutes of the press conference was all talking about jobs and employment. And what we're looking at here, and the gold line is the unemployment rate. It's been moving up significantly off 3.5% last summer, now up to 4.2. And jobs, just the total payrolls number, is the blue line. Don't get a whole lot of a signal out of the blue line. It's a coincident indicator. If you were to go back and look at recessions, the recession starts, they date the recession to when that number starts coming down, almost perfectly. So right now, from at least the data, and there's tons of revisions that come to it, what it really would tell you is we're not in recession now. Doesn't really give you a whole lot of forecasting ability. But this was the main focus of saying, we like where we are. The Fed likes where the employment numbers are. They really wanted to keep them there. That was the main focus. Anywhere in the low fours on unemployment is where they feel comfortable, and they are forecasting out, which will look a little bit higher in unemployment. But this is where they're really comfortable.
Right, and you know that I've criticized this Fed model for quite some time. It's something that was put together 100 years ago, and there is not this inverse relationship with inflation and unemployment. The 70s proved that. One reason that I would discount this going forward is just the demographics of the country. As the baby boomers are retiring and we're getting the Gen Z come up, we're going to be about 15 million people short, and that's assuming a similar participation rate. With the wealth transfer, that probably lowers, I've seen somewhere between 62% versus a historic 68%. So I think this is another one of those indicators that they're certainly going to be watching. And I'm not saying that it can't go up, it certainly can. But I think there are going to be more labor shortages going forward than, let's say, 20, 30 years ago. The way that the economy worked several decades ago, it just isn't going to be the way that it works going forward.
Right. And let's move to something that's more forward-looking, which is the leading economic indicators, the LEI, the index. And what we have here, speaking of models that aren't perfect, is a model that worked really, really well historically until the last 18 months or so, when it actually was signaling recession, a recession that we either have not gotten or are not going to get. And what we're seeing here is that we're on the right track, at least from some of these leading economic indicators. It's not signaling recession anymore. That's the blue line starting to move back positive, not strongly, but it is moving away from some of those negative signals. And it does work with a lag. That was an August report. What I've shown here is that we have a couple reports since then, this will be released next week, that are showing on the right trend. So the first is the interest rate spread, the yield curve, the 10-year minus, they use the Fed funds rate. We often use the 2-year. Well, the Fed funds rate just came down 50 basis points. That's going to be a less inverted yield curve. We're starting to move towards a positive yield curve. That will improve. We have many consumer reports and sentiment indicators since then that are showing a positive move higher. That one's probably the strange one because you get a lot of volatility around the election. Right? No matter what happens, a big group of people are not going to be happy, and therefore their sentiment reports will get a little weaker. And then we had this morning, housing. You mentioned it. Permits were up 5%. That's a leading indicator, and starts were up 10%. So those were good signs, at least for where the LEI is headed. Let's get into what we talked about, which was the Fed. The summary of economic projections is the median expectation from everyone at the Fed with what they are expecting going forward by year. First thing to note, there's a 50 basis point cut today. There was one dissent, actually. Governor Bowman wanted only a 25 basis point cut. First time there's been a dissent in a couple of years. Remember Bullard from St. Louis, where he was speaking out a little bit differently.
He was always a maverick.
Yeah. So he was the last one. But what we have here, I put 2 green lines and 1 red. We talked about unemployment at 4.2. They're saying that they see it going to 4.4 by the end of this year, holding steady there for a year, maybe coming down. The longer term, obviously, forecasting is not very accurate. But this was something we mentioned last quarter when they came out the projection saying unemployment is going to be at 4 by the end of the year. That's the line below this. So that made no sense to us. Unemployment was already headed towards 4. They didn't know how they came up with that projection. So that was one that they did miss. But going to the inflation number, 2.3 by the end of the year, that's strong disinflation from what we have seen. And 2.1 by end of 2025, that's them saying we basically think we'll hit our target. They want to get that to 2. They probably think they're going to hit it next year. So those are positive signals. I think the market, whether it was perceived that way today, it will be perceived positively going forward. And then the big one is, what are they doing with interest rates going forward? That's the bottom bar there. They're saying by the end of the year, 4.4 is where they expect the median of cuts to be. So a couple more cuts coming by the end of the year. And then moving to the end of 2025, 3.4, just a lot more cuts as well. Something that we thought that they may show this in the report, but that the market may have been getting a little ahead of it, pricing it in. But I think the market actually priced this in pretty accurately with what ended up being released.
And I think the only thing that I would challenge on the thing, well, one, unemployment is still under 5%. Historically, that was said full employment, right? The other thing is those inflation numbers. I think if the Fed fund really is down at 3%, whenever we take those shelter costs and what would probably happen in the housing market, to me, those are a little bit of a mismatch. But these are strong numbers. There's a reason the market is probably going to be moving up from here.
One thing you mentioned that I didn't call attention to on the chart is that real rates being back or more here for more of the medium term. That's something that they've been constantly pushing higher in here, which is showing at the longer term expectation. They've been raising that. They used to, if we pulled this from several quarters ago, they thought they would bring rates back down to 2.2, 2 to 2.5. Now they're saying in the long term 2.9
right.
for the rates. So exactly what you were saying.
Absolutely. They're still saying that there's going to be a real rate on the Fed funds rate. So you can hold money in cash, and after inflation and taxes, hopefully you're still ahead.
Yeah. And let's just close with, where do we think rates are going? You mentioned cash. We have a lot of cash for portfolios for taking distributions, and when we take what they just said, it's pretty easy to estimate where 2024 the yields will have been for the whole calendar. Probably think before fees it will be about 5% is what we will have averaged throughout the year, and going forward to 2025 somewhere in the high 3s. Unless there's some significant cuts, I think we're still going to see strong returns from our cash. Now, I don't think it's an asset class we want to be adding to relative to other areas, especially as they start to cut rates more aggressively than this going forward, because we're looking more than just 2 years when we're making asset allocation decisions. But I like where our strategy is set up for cash for the short term.
Makes a lot of sense. And then because we hold a decent amount of cash, we can always overweight equities, which seems like this would be if this environment unfolds, it's probably very strong for equities.
So really to summarize, right, we got the 50 basis point cut. We said it was about 50-50 with what expectations were for today, whether it was going to be 25 or 50. Projections were pretty much in line with the market had seen. Going to make us change probably nothing from the way we're allocated from an equity standpoint. Our thesis in the medium term has been broadening out the markets away from some of those mega caps, adding to small, mid caps. I think this is only going to help with that. So I don't think we're making any changes for where that's headed. Fixed income as well. We've been pretty neutral on duration for relative to where the market is with benchmarks. So I don't think we're making any changes there either. It's pretty much a status quo report that I think in the long term will be perceived as bullish, but at least in the short term, like you said, it's going to be a little bit of a heartbeat.
Yeah, just looking at it, looks like small and mid are running, and I'm sure that has to do with the variable rates on their balance sheet. So we're exactly where we need to be if that's going to be the thesis going forward.
Thank you for joining us for September. Next month, we will be with the founder of GLD, so don't forget to subscribe so you don't miss that episode.